Wednesday's market closes mixed in cattle and grains, but a higher day in the hogs. Joining us to visit about that, Total Farm Marketing's Brian Doherty. Brian, another pullback in corn and soybeans. I know we're removing weather premium. How much more weather premium do you think we need to take out of these markets? And is it just that, or are we still seeing fund liquidation?
It's both. You're seeing more and more, let's say, liquidation from, I think, funds and smaller speculators who are getting tired of margin calls or the market's not moving on their speed. Or if you look at what happened here this last Sunday night, Monday, same thing that happened the last week prior, Sunday night, Monday. Big gains, only to give it all back. It's getting disappointing. The market's at a really interesting pivot point. Prices can go lower if the crop continues to move along toward maturity. There's a lot of question on that, in particular where it's very dry and very hot. So are we cumulatively adding bushels week to week to week? I would say we're at the USDA number and probably nothing more. So in theory, we're getting close to a low, but never underestimate the technical ability for the market to go a little further than people expect. That'd put us around the $5.25, $5 area in December, should prices break support near the 575 mark in December.
And what about soybeans? Will they take out the July lows as well? I know August is really when we determine how big that crop is going to be.
My best guess would be if they take out the July low, it comes probably in another week or two. I just don't think we're poised to see this thing really catapult lower right now. We're too tight on inventory. The world's too tight on inventory. The world's depending on big and large crops out of the northern hemisphere. So if we do, it's probably another couple of weeks when we get a little more weather and confidence. When I say we, the market gets confidence to hedge or to sell at lower values. Right now, beans are really on sale to the world. They're at a cheap level compared to where they've been. And that should, in the long run, spur export interest. And we started seeing some of that develop again here this week with China stepping into the market.
Yeah, 5 million bushels new crop, but do you think they'll be in for more because they've certainly bought a lot from Brazil, even though at times, our prices did dip below theirs?
They will. They'll buy. I think what you've seen is China being smart, being China. They've been moving beans out of reserve, and they do that in a downtrending U.S. market. They're declining their supply. We have the inventory coming. They'll be back purchasing. Brazil, they have a big projected crop, but that's not available to the market till probably deep in February or March. So we are the go-to market. A lot of talk earlier in spring that Brazil would be out of beans by about August, mid-August.
So what about soybean oil? Because that's been another drag on this soybean market. We saw that in spades on Wednesday, following the crude oil market, isn't it?
It's following the crude oil, but it's also following the palm oil market. Palm oil
that too.
markets, big supplies, big decreases. If you might remember, Indonesia along the way was limiting exports. That opened back up. So the world's a little bit less concerned about, one, palm oil supplies, and then two, it just seems like out of the Ukraine, Russia region that something's going to give way to have some of this product move to the export sector. It seems that way when you read day-to-day news. You can take your bet on it. But sunflower oil, you're just not seeing the upward momentum that we had from the world kind of chasing perceived tight supply. Supplies are still tight, but oil's been sort of the weak link of the complex as of late and hasn't shown any sign of turning around yet.
And certainly wheat has been following these Ukraine discussions, but really how much wheat can we bring through those export channels? We're not going to get back to the levels we were before we started the war.
I think the money flow is the problem in wheat. The money flow has moved out because when you look at the price of wheat where it is now, you talk about the war, you talk about wheat stuck in transit or stuck in silos, wheat that will be harvested now that doesn't have a home to go to in Ukraine. And then you look at our harvest season, how far along we are. There really isn't a lot of reason to expect downside pressure on wheat for wheat's sake. That's increasing supply or some other fundamental. It's really a matter of the money flow. It pushed out of wheat, it got beat up. I don't want to overpromise here, but I wouldn't be surprised at all if soon we see the money flow move right back into wheat as the world recognizes that it can't flow enough wheat to meet demand out of the Black Sea region in the very near future.
Yeah, it definitely looks undervalued at this point. What about this cattle market? Live cattle pushing right up into chart resistance there again. Boxes have been pretty solid here and whatnot. What's it going to take to push through those areas?
Well, it's going to take more consumer demand, and that's the big question mark. Continuous recessionary talk, but you look at the stock market, had a pretty good rebound, maybe a little more confidence, some talk that maybe interest rates will peak on one more push higher. We'll find that out. Some not so optimistic that'll be the case, but maybe a little bit of light at the end of the tunnel. I also think, too, the consumers have gotten kind of used to higher prices. There's always sticker shock. Gasoline prices come down. People want to still go out. They want to eat out. So we're bullish the meat market from a supply perspective. It's whether or not we can get enough demand revved up there, and that's the wet rego or the beef market, like any of these other markets. Not only actual demand, but perceived demand. China lockdowns, not a good. If you're looking at, well, where's the export market? When you're locking down China for COVID, you got to temper your bullishness back despite tight supplies. I ultimately like the cattle market maybe in a bigger move higher, but I'm really cautious. I'm encouraging producers to look at put options to floor it as a safety valve and try and leave the top side open.
And the same recessionary concerns have obviously impacted the milk market here. Are we going to go sub 20?
Everything's relative. So when we were pushing above 20 the first go around, we were like, boy, this is pretty great. Maybe we can get 21, 22. And then we push to that, and then you get 24, 25. And you start hearing talk of $30 milk. To come back off of 25, that's realistic. That's a big number from a demand perspective to maintain. Drop back down to this 20. It's hard to get bearish milk at these levels. It's like all other markets. You can lay one over the other. The charts all look the same. This is a money flow out. Things have corrected back. It's easier for the consumer to pick up more inventory. That those lower milk futures will be reflected in lower cheese and lower milk prices in the store soon. Look for consumer demand to begin to pick up. Keep in mind, coming out of this COVID, there's about $2 trillion checkable dollars. That is extra money that consumers had in their savings compared to before the pandemic.
Okay. Thanks so much for joining us, Brian Doherty with Total Farm Marketing.